Hello. What I want to cover in this video is give you some of the data that we've come across from analyzing brokerages, traders that were using these brokerages over a 4-year period. There were some 400 traders, and we examined all the trades that they did to see who was making money, who wasn't. Now, this is the kind of data which has never before been available to private investors because brokers don't have an incentive in doing this. We have access to our own brokerage data, and that's why we were able to analyze it. The reason this is valuable, or actually invaluable, is because private investors often don't know who of their clients are the ones making the money, who of their colleagues are making money, and what it is that they're doing. Of course, you always get anecdotal evidence, you'll always get the trite advice from people saying you've got to be disciplined, you've got to do this, you've got to do that, and they'll give these talks and so on and fill them up with not very specific examples. What we've done in gathering all this raw data across such a long period among so many traders is reinforce what we knew to be accurate, but with specific actual examples. So let's get on with this series of videos which will go into all of that detail. The first thing that I want to do is just tell you a bit about what other information you can get to connect up with me. You can see over there, you can connect up with me on Facebook, and I often put trading information and so on there. I also put a lot of other information just from travels and so on. Twitter tends to be mainly trades and trading advice. The blog, as you'd expect, has purely trading related information, so I might talk about specific trades which I think are coming up which look good. I might put in information that I found from various other sources, whether it's Goldman's research report or whatever else it is. We've created a whole series of education information on investingbetter.com, as you can see there, and brokerage data, Alpesh B.Patel spreads.com, which has now become and merged with sterlingmarkets.com. You can see up there as well. So feel free to make a note of all of those and connect up with me through them. It'll enhance all the data and information that we're speaking of here. So let's start off with the first thing. Now you'll see that I've put up here word confidential. I'm not playing around. The reason we've actually put that is because the amount of data that we got, we think this is amazing proprietary information. We're going to actually publish a book out of this to be published by the Financial Times, and we're pretty excited about this because, as I say, nobody else has taken all this information from actual trades placed by traders, retail clients, and analyzed them to see what are the holding periods that winning traders have, what are the holding periods losing traders have. Do you make money when something goes long? Do they tend to make money when it goes short? What kinds of trading strategies do they look to be adopting, and so on. So this is critical for truly understanding how to be in the top percentage who are making the money. Also, one of the things we disclose is what percentage make money and what percentage don't as well. So let's carry on. One of the things that we found amongst the traders who win is that once a security has risen 10% into profit, so whatever they've bought or sold, whatever they've gone long or short on, so let's say it was Vodafone stock and they got in at 100 pence. Once it had gone to 110, if it then went back below that 100 pence entry, that trade was less likely to make money for them. And the point here is that they were very good at either getting out or having set their exits in such a manner that a profit would not become a loss. Now, you may think, well, wait a minute, surely if you hold it long enough, it'll turn around. Surely 10% is not big enough, and so on and so forth. This is just what we're telling you. Statistically, when we analyze the trades that were undertaken by the winners and the losers, what we found is that the winning trades and the losing trades had this differentiation. The losing trades would often be cases where a security has gone up 10% into profit, a trade's gone up into 10% profit, and then goes into a loss. And losing traders tended to hold on to that, hoping that it'll return into profit. Winning traders got out when it looked like a winning trade was about to become a loss. That's the first point I wanted to make. Second point, some make money who are right only 4 times out of 10. Now, you might think, well, that just doesn't make sense. How can you make money if you're only right 4 times out of 10? What we found is some of the winning traders were able to be right only 4 times, but the money they made on the 4 times they were right was more than the money they lost on the 6 times they were wrong, which meant that the 6 times they were wrong, the losses were relatively small. This is very important because it meant that when they had losses, in other words, when they knew they were wrong, they got out very quickly and they had very small losses. And the winners, as I say, not all of the winners were only right 4 times out of 10. What I'm saying is some of the winners were right as that they weren't going to be right more times than they were wrong.